Welcome to Multibagger Shares. I'm Manish Goel, SEBI registered research analyst, and today we're diving deep into one of the most underrated yet powerful fundamental metrics in stock analysis, the inventory turnover ratio. Let me ask you a simple question. Imagine two companies, both reporting 100 crore rupees in revenue. Company A sells and replaces its entire inventory 10 times a year. Company B only manages to do it twice. Which one is the better business? The answer is obvious. Company A is far more efficient. But here's the thing. Most Indian retail investors never even look at this metric. So what exactly is the inventory turnover ratio? It's calculated by dividing the cost of goods sold by the average inventory for the period. The result tells you how many times a company sells through its entire stock in 1 year. For example, if a company has a cost of goods sold of 24 crore rupees and average inventory of 4 crore rupees, its inventory turnover is 6 times. That means the company sells and replaces its entire inventory roughly every 2 months. You can also calculate days sales of inventory by dividing 365 by the turnover ratio. In this case, about 61 days. Why does this matter so much? Because inventory is essentially cash that's been converted into products sitting in a warehouse. Every single day that inventory sits unsold, the company is paying for storage, insurance, and bearing the risk of that product becoming obsolete. The longer inventory sits, the more cash is trapped. Cash that could have been used for growth, dividends, or debt reduction. Let me give you some real Indian examples. Avenue Supermarts, which runs DMart, has an inventory turnover of approximately 11.8 times. That means DMart sells through its entire store inventory roughly every 31 days. This extraordinary efficiency is a core reason why Radhakishan Damani's retail empire generates massive free cash flow despite operating on razor-thin margins. Hindustan Unilever operates with an inventory turnover of approximately 7 times. Their decades-long investment in distribution networks means products flow through the supply chain rapidly. This is a genuine competitive moat. Now, different industries have naturally different turnover levels. FMCG and retail companies typically operate between 8 to 15 times. Auto components and chemicals usually fall in the 4 to 8 range. Real estate and heavy machinery companies might be below 2 times. The key insight is, always compare a company against its own industry peers, never across different industries. Here are the red flags you must watch for. First, declining turnover over time. If a company's inventory turnover has been dropping over 3 to 5 years, demand may be weakening or management may be overproducing. Second, inventory growing faster than revenue. If revenue grew 15% but inventory grew 40%, that mismatch is a ticking time bomb. Third, turnover significantly below industry peers. This signals operational weakness. Let's talk about Titan Biotech. Currently trading at approximately 529 rupees per share post the February 2026 stock split. As a manufacturer of biotech raw materials like agar-agar, peptones, and culture media, inventory management is critical. Titan Biotech's near debt-free balance sheet with a debt-to-equity ratio of just 0.02 tells you this company doesn't need to borrow to finance working capital, a luxury only operationally efficient companies enjoy. The promoter holding of approximately 55.87%, with promoters consistently increasing their stake, further validates operational efficiency. Here's my step-by-step framework for analyzing inventory turnover. Step 1. Calculate the ratio over 5 years using data from screener.in. Step 2. Compare against 3 to 5 direct industry peers. Step 3. Cross-reference with operating cash flow. Step 4. Check inventory composition in annual report notes. Step 5. Link it to the complete cash conversion cycle. Now, a critical point. As Warren Buffett says, wide diversification is only required when investors do not understand what they are doing. When you deeply understand a company's inventory dynamics, cash conversion cycle, and operational efficiency, you don't need 50 stocks. You need conviction in your best 5 to 10 ideas. The greatest investors, Buffett, Munger, Pabrai, Jhunjhunwala, all practiced concentrated investing, not diversification. And please, stop gambling in futures and options. According to SEBI's own study, 9 out of 10 individual traders in the F&O segment incurred net losses. Focus on understanding businesses deeply through metrics like inventory turnover, and build a concentrated portfolio of quality compounders. To learn our complete 95-factor fundamental analysis framework, check out our free value investing course. Link in the description below. This is Manish Goel from Multibagger Shares. Remember, study the business, understand the operations, and invest with conviction. Thank you for watching.